Hello, everybody. This is SIA, and we are absolutely pleased to have you for the first video call that we do with us. We do that on a regular basis, so usually twice a year at least. With that, don't like to use any time and would start immediately with the first part of the presentation, which will be basically focusing on the impact of COVID. Carlos, can I basically hand over to you?
Mm-hmm. Okay, thank you, Alex. Well, as you can see, I mean, our idea is to briefly touch on how is COVID affecting our investments in general, and particularly our investments. Now, you know all about it, you read about it every day, so we're not going to tell you anything new about the epidemic. Here you have some 4 charts, 4 countries, there could be any other countries, where you see that the second wave has been very, very important compared to the first one. That's the blue shade. But the red shade or pink shade is the mortality, the number of deaths. And by the way, the scale is not the same, because if the scale were the same, you could not see the line. It is very, very small, fortunately. So what you see is that even if the number of cases in most countries has surpassed the first wave, the number of deaths has not followed at all. Now, there are many reasons for that, and obviously the basic one, I mean, nobody knows, but one reason, as you can see in the following slides, I mean, is that this is affecting only older people, mortality. This is a little bit like the normal flu. One doesn't think of the flu as a deadly disease, but as you all know, of course, every year kills lots of people. And most of them are older people or fragile, weaker people. And the same is happening with this thing. As you can see in the following slide, we have learned a few things from this exercise so far. The first is that lockdown works. In the first wave, which of course was the first time, the whole thing was growing very fast, nobody knew what to do, hospitals were filling up, etc., etc. Authorities in many countries set up tight lockdowns, and sure enough, 2-3 weeks later, the whole thing turned around. And it turned around to the point that, for instance, in Switzerland, we went for several weeks with almost 0 new cases. Then the holidays came, and then everybody started traveling, and then the whole thing started spreading again. Now, what we have had in the last 2 weeks, of course, is new lockdown measures. And what we have seen in the last few days, as we should expect from our previous experience, is that cases are already flattening or turning down in practically all countries which have established new measures. So we're going to be stuck in this situation in which measures to contain the disease work, and then we open up, and then the contagion goes up again, and then goes on and on. Although with a much, much lower mortality, doctors know how to treat the patients, the disease is much better known than, of course, at the beginning, so the situation is much less serious. And in fact, most of the lockdown measures that have been implemented, particularly in Europe, are much less strict than they were in May, and yet the contagions are going down. So how does that affect us? We can see in the next slide. In the short term, we're stuck with this, but of course, in the medium term, and by medium term we mean a few months, vaccines and treatments are coming. We wrote this slide actually before Pfizer announced on Monday that their vaccine was very effective. There are 2 treatments which have already been approved, that they cure the disease, but only when it is not very advanced. People are not talking too much about them because, of course, it is much better to have a vaccine and not have the disease than to cure the disease. But they work. In fact, you can ask President Trump about the Regeneron treatment, and being a person at high risk because of his age and weight, he recovered in less than a week. I mean, these things do work. And then the vaccines, which are basically based on the same technology, of course, work. If one technology works, then it keeps working. People have been sometimes skeptical, but the truth is that the antibody technology works, that mankind has never spent so much money suddenly on a given health problem. And as you would expect, eventually it is working. Now, Pfizer gave very good results on Monday. Moderna, which has basically the same vaccine, will give results next week. The AstraZeneca, which is a different technology, seems to be working too, and that should be announced in 2-3 weeks, and approvals will start arriving in December. On top of this, you have now 4 vaccines in China, which are already being used. And the reality is that there is no virus in China, so they must be doing something right. And the Russian vaccine, the Sputnik 5, they have not produced the data in a kind of internationally agreed format yet, but it seems to be working, which is to be expected because the underlying technology, again, is similar. So all this means that by the spring, before the summer, vaccines should be widely available. They have already been produced. Governments and some private foundations gave money to the pharma companies to start producing the vaccines even before they were approved. So to take the risk away and to make sure that the day they're approved, there are already at least some million doses available. Okay, so this is what we should expect. Now, how does this affect investors? We are, at the end of the day, we've always insisted that we don't see asset management or money management as just playing games and playing the market and this and that, but just we become owners of businesses. Now, how does this affect business? And of course, different businesses are affected in very different ways. We've taken here kind of 4 categories of business by how they are affected by the virus. The first category would be what we call lottery winners. And of course, the extreme example is the one we're using right now, which is Zoom. It's a company that, it was there very small, and they had a good product. And of course, because they had a good product, when the situation, the lockdown arrived, it boomed. But there are more mundane things like companies making disinfectants, which we happen to own by chance. I guess obviously we did not expect this, but now they're selling much more disinfectant than in the past. Very good margins and making good money. And you have all kinds of companies that are profiting from this. Eventually, even some gas companies like industrial gases that you need to keep things frozen and refrigerated, which the vaccines need. Well, there will be a huge demand for that, etc., etc. Now, of course, this is excellent for them. It's like hitting the lottery. But like hitting the lottery is not something you can build a business on. So this is temporary. I mean, it's good for them, but it will pass. And it's very important not to give these companies valuations that assume that these profits are somehow permanent, because they will not be. Many companies are unaffected. We put here 2 examples of companies we have in the portfolio, but of course there are thousands. We have Devro, that makes sausage casings, the skin of the sausages that we eat, or Prysmian, that makes cables for electrical transportation, utilities, the grid, etc. They're basically selling the same as they would. Sometimes you have a bit of a problem because a given place is disrupted because people are not working, but it just you catch up very quickly. So for these companies, this is truly a non-event. Now, for many companies, we could say probably the majority of companies, this is a temporary hit. This is bad news. It's a bad year. You have a company like Sodexo, which Marcos will discuss in more detail later, but that runs cafeterias for companies, universities, hospitals. Now, if the company is shut down, well, there is no cafeteria there. So this is a very bad year. Of course, the hospital is still running, unfortunately, even more so than before. So things are not dead, but Suncor, an oil producing company. Well, if you have to sell oil at 35 instead of 55, well, your profits are going to be very, very different. Now, we call this a temporary hit because these companies actually have maintained positive cash flows. So they'll go through the year, it will be a bad year. But once we're back to normal in, say, 1 year time, they will be back to where they were before. And the company will be worth exactly the same as it was worth before. But then there is a fourth category, which we call here crippled. I mean, for some companies, the loss, cash flow this year becomes negative. I mean, think of course, airlines, hotels, cruise lines, some restaurants, companies which actually have to shut down, but keep costs high. Those companies are losing so much money. You know, losing money is not a theoretical concept. You know, it's your money coming out of your bank account, and eventually there is no more money in the bank account. And then you have to put more money in the bank account. Now, there are basically two ways of doing it. Well, three. One is you shut down the company. Two, you issue shares, so you raise money that way, or you issue debt, so you borrow it. But the problem is, once you have issued shares, for example, even if the company goes back to the same value it had before, because people start flying again and everything is as it was before, so you can make the argument that the company is worth as much as it was before, correctly. The problem is now there are many more owners, there are many more shares, and therefore the value per share is permanently down. So that is very important when we see some share prices very low to say, look, how much this thing is down, it should recover. Well, it should or it should not, it depends. It will recover, obviously, because things will be better. But there is no reason why things should go in terms of prices of shares to where they were before, contrary to the previous case. So it's important to understand our given businesses where they are. Fortunately, we have basically no companies on the fourth category, and we have basically on the first three. Okay, so that's for the thing. In the end, it's a bad year for business owners. I mean, that is the truth. I was looking at dividends, which is the ultimate, obviously, proof. Although there are many more things than dividends in our own companies, but dividends are the ultimate proof because, you know, this is cash actually paid to the shareholders. Now, dividends in the Standard & Poor's 500 this year are probably going to be between 5 and 10% less than last year. And that's the way it is. On the one hand, you can think that this is, again, proof that owning a diversified portfolio of equities is a very safe investment, because having something that had never happened before, a pandemic like this that shuts down the world economy, you still get your dividends just 10% less, actually less, 5% is the expectation than last year. So, of course, if you invest in bonds and your bonds work, the good news is you get the same coupon as last year. The bad news is that you get -1 like last year, so depending on the bonds. So it's much better to get 10% less of a high dividend than the same of the same extremely low bond coupon. So, but the reason equities pay more and are a very good investment is because we have years like this, of course, and people don't like, for the same price, we would all like to have exactly the same payouts every year. Now, equities cannot do that. Now, since there are so many things that cannot be forecast, this proves again the importance of two things: diversification and financial conservatism. If you are highly leveraged, you have debt, something out of the blue like this pandemic simply kills you. You cannot just recover. But if you are well diversified, even if you have some businesses that actually suffer a lot, well, the others will not. And over time, it is a much better investment. So this is what we had on the impact on our companies.
Perfect. With that, I would like to basically pass on to Marcos.
Yes, hello everybody. I'm going to go through the next part of the presentation, basically just summing up a little bit what is our macro perspective. You know that we are not macro guys, so we are not basing our investments on macro forecasts, but we try to have a view on what is going on in order to avoid issues and to try to understand the risks. And then I will go down to the classic to touch upon the performance, and then I will go down to two companies. I'm going to just describe two of the holdings we have. So in the first chart here, what we see is the industrial cycle. The industrial cycle, basically, we've been following for many, many years. And it's a very good indicator because it's early and it moves relatively well in the past. You have peak to trough movements of 2 years. So the cycle, it's global industrial and normally peaks 2 years after the trough and then goes down in this movement of 2 years. What we can see here is that the second quarter of 2020, we saw the trough. And this is a bit late because we were expecting the trough earlier, but the COVID-19 just extended the downturn. But now the third quarter has been much better, and we should expect that the new cycle that has started in the third quarter will move up in the next couple of years. If we move to the next slide, you can see basically the same shape, but rather than the global industrial cycle, this is the manufacturing PMIs. You see the crisis in 08 and 09, which was massive and longer than the current one. But the important message here is that globally speaking, the PMIs are back to positive territory, anticipating both in terms of headline and new orders, a new upward cycle. And the last slide I wanted to comment on bottom-down approach is the US cycle. This is a chart we have borrowed from our friends from Deutsche Bank. Basically, what you can see is what they expect for the US economy for the next 2 years, and this is pretty much in line with consensus. Basically, you see that without any stimulus, the economy would be back to 2019 already in the end of 21. But if you're adding stimulus, 1 trillion or 2 trillion, then even the US economy would be back to the trend, to the previous growth trend. So net, the US economy looks like is improving very well, and we should see a recovery as from 2021. Just to sum up what we think, China is back to normal. The US, as we saw, is ahead of Europe in terms of recovery, and the stimulus is expected to be approved soon. And these two economies are 40% of the world economy. Then we have medicines and vaccines, as Carlos was saying, that are around the corner. So they're going to be approved, and this is going to have an impact in the next 6 months. Then we have the government support measures that are massive, between 5 and 15% of GDP. These metrics are massive, and they will help the economies to replace the loss of private demand. And finally, and this is very important because it's very different from previous crises, is that the flow of credit is being maintained. Banks are working and lending is working, and there's not a big issue in terms of credit flow. So this is our approach to 2021, 2022 in terms of macro. Let's move to the classic. The classic fund has been this year all around. So in January, we were at 450 euros per share. In March, we troughed at 250, and the fund is now at 380 something. So, you know, a little bit crazy movement this year, which is normal in a recession and a recovery phase, but, you know, not too good to be an efficient market believer. Basically, you know, summing up, normally in a recession, cyclical stocks, small companies, value, leverage, underperforms. And in the recovery, in the cyclical recovery, these companies tend to beat the indices, and we expect this to happen again. Classic is very well diversified. We own 30, 35 companies, very little industrial risk, and we think that in a year or maximum 2 years, we will be back to normal. The next slide, you can see a little bit the look through of the classic. I'm not going to go through everything, but we have been through choosing stocks, you know, bottom up. We are ending in 7, 8 sectors that look very promising to us. So I'm going to go through them very fast. Aerospace, catering and services, salmon farming, healthcare, building materials, oil and copper. These 7 sectors account for more or less 2/3 of the classic fund. And in all of them, we think that the impact of the COVID has been temporary. This means that in the next couple of years, all these sectors, all these companies you can see here will be back to normal, and we should make a good performance on that. 40% of the fund, so the rest of the fund, is invested not really in sectors, but in different stocks like Prismian that Carlos mentioned, or Pandora, or ING, the bank, Visa, etc. I will go later on to comment 2 of them in detail. Basically, I'm summing up, 50% of the fund is now in category 1 and 2 risk. This means low risk, and 50% can be seen as a compounder or a quality part of the fund. The fund is very cheap, so it's true that it has recovered from the lows, but on our numbers, it's yielding a 16% IRR, and the updated intrinsic value is 600. We withdrawn the target for this year, although you know that we like to put targets. We withdrawn the target for 2020, which was, if I recall well, 450, and we moved to the 2021 target, which is 500 euros per share. This is calculated using normal EPSs or normal profits or normal cash flows and applying normal valuations. So on a fundamental basis, it's easy to explain because we should recover the 2020 loss, although we are doing well to catch up this year. And also we should catch up the recovery in both value and commodities. So it looks good from this perspective. Let me go a little bit more in detail, although maybe it's a bit too much detail, but if you apply normal valuations, if you look at the classic, on an average, return on equity on average for the different holdings is 15 to 6% return on equity. And usually a company or a holding that gives this return on equity trades above 2 times book value. So if we take the book value we have for the fund, which is almost to 70 euros per share 2022, we apply 2 times or 2 point something, we already go to between 500 and 600. So this is a very easy way to understand the value in the fund. You can do the same on a PE basis. So on these numbers, the PE of the fund is around 12 times, but any company with a return which is 15, 16% normally trades at 15, 16 times, even a bit more. So if you apply 16 times to the 28 euros per share EPS 2022, you already go to close to 600. And my belief is these 28 are understated. Probably the EPS 2022 will be higher. Going to the next slide, I will go fast to 2 holdings we have that are very important for us because all of them are big positions. We are relatively well concentrated. First one is Sodexo, leader in catering, well-known company, is French, 20 billion sales, 4 business lines. They have businesses and administrations, education, seniors, healthcare. We like the business because it's very fragmented. The total market, as you see in the chart, is 350 billion, and the main players only have 7%. So there's 2 trends that are helping the sector. One is it is fragmented, so there is consolidation, and these guys being the leaders, they do it normally well. And the second trend we like is the outsourcing trend, which is ongoing because most companies, more administrations, schools, universities are outsourcing food or catering or facility management. Returns are good. 10, 11% return on invested capital after taxes, return on equity close to 20%, and we believe that 5% annual growth, including acquisitions, can be done. So it's a good business, resilient, a company which is a good quality company. If you go to the next slide, you can see how the company has performed in the COVID. From a stock market perspective, it has been awful. The stock was trading at 110 euros in the beginning of the year, went down to 50. Now it has recovered a little bit, but still trading below 70. The COVID-19 crisis has had an impact, but as Carlos said, it's only a temporary impact. There's no fundamental change here. And the important thing here is to analyze the cash flow, because the company will produce positive cash flow in the in the COVID-19 crisis, which means that, you know, in a couple of years' time, we will be back to normal. Strong balance sheet, strong solvency and liquidity. So in order to value this, there's a very, very easy way to do it, which is applying the average PE that the company has been trading for many, many years to the EPS of 2023, which, by the way, we took a similar level of 2019, 5 euros per share. You apply 21, you get these 105 euros per share. The next holding I would like to touch briefly is ING. ING is a very simple bank, although it's big. It's a leading European bank. It's also very advanced in terms of digitalization. It is not a fintech, we admit, but it's, you know, compared with the peers, it's a good digitalized bank, limited growth, so it's not a growth stock, good management, they are very conservative, good balance sheet, common equity tier 1, 15% or more, and decent returns on normal markets. Not on a recession, because this year probably the return will be single digit, but 2019, 2018, these guys were making 10 to 12% return on tangible equity. In the next slide, you can see how's the valuation. The company, the bank is trading at 0.405 times book per share, when, you know, the return of this company can be easily in the next 2-3 years 10-12%. So if you're given a company at 0.4 times book and they are making 10-12% return on this book, you can make 20% return or more. And this is what our numbers suggest. On our valuation, ING would be around 20% internal rate of return at current prices. Our intrinsic value is 15. Then the stock is trading around 7 euros, I think now. And the PE 2022 is below 6 times. So dividend yield close to 10%. So really, we think this is a mistake from the market. Now I will hand over to Alex.
Thanks a lot, Marcos. And I would like to pass on now the microphone to Urs on the unique investment opportunity in natural resources.
Thanks, Alex. Good morning. So obviously, as everybody has seen, the volatility is very big in commodities. We have taken the opportunity of the huge volatility to increase our exposure, particularly in energy, in oil, and decreasing it in the more stable and defensive agri and infrastructure segment. So the fund is now positioned with 40%, something more, 40% investment in energy, with a focus of upstream oil, and another 40% in mining, with a focus on base metals, so mainly copper, nickel, zinc, some uranium exposure. And that's how the fund is positioned at the moment. Maybe next slide, Alex. So of course we have elaborated for a long time now about these commodity cycles. Here you see the Goldman Sachs Commodity Index in relation to the S&P, and we have the lowest level for the last 67 years, and only twice the valuations or the prices of commodities, I have to say, have been as low as now. It was the start of the inflationary 70s, and it was at the millennium, and both of these situations were followed by the biggest commodity bull markets. We have a lot of presentations about this, how this under and over investment in capex in commodities create oversupply and undersupply, and therefore we see these cycles. Just quickly remind that we had high commodity prices into 96, oversupply. Commodity prices troughed in the year 2000, and then they multiplied by 10. And then from 2007 onwards till 11, we saw a huge explosion in capex, in investments, in new mines, fields, etc. And then from 11 onwards, we saw again oversupply and the collapse of prices. And now we have a decade behind us of massive underinvestments. Maybe what also could be different, just to go back, Alex, what could be different in the next decade is that the last decade we saw mainly monetary policy stimulus, which benefited more to the growth cash flows, which are far away. and we saw this health gap, this wealth gap widening. And I think now we have started a process where the stimulus is coming more from the fiscal side. The money has to go to the street to have the broad economy benefiting from it. And obviously it will go into infrastructure, into defense, social programs, etc., which historically was rather benefiting, obviously, the consumption of real goods and services and also commodities. So the next slide, just a few words about the oil market. We had in the oil market in March, given the shutdown, a complete collapse of demand, and obviously therefore a huge oversupply, which drove the oil prices, even some of them, into negative territory. But this has been adjusting quite quickly. Demand was coming back, and particularly the supply was going down and cut. And we had the situation now that, as an example, from January to October, China had an oil import growth of 10.6%, an import growth of gas of 4.7%, and on the contrary, a negative growth of imports in coal of 8.6%. So that shows maybe a bit that there was some stocking going on in China, because obviously in the first 10 months of this year, it's not possible that the Chinese economy grew 11%, but gas might be a more reliable figure, as it's even more difficult to store with 4.7%. So we have seen probably some stocking effects in oil, some destocking in coal, which was also due to the import restrictions from Australia. But I want to point out that after summer, when probably the economy was recovering the most, we had a deficit of 5 million barrels per day, which is quite a huge figure. I guess it's coming down a bit due to some renewed lockups, even if they're milder ones, and the stocking effect in China. But the production deficit of 5 million barrels per day is representing 5% of the whole oil market. And if you go back to the oil crisis of the 70s, we had like 3 virtually supply effects then. These huge crises virtually were triggered by this kind of deficits due to supply disruptions. So I think we still have inventories which are obviously going down with deficits, and I think according to our calculation, we should reach normal levels in Q1 21. But if we're going to maintain such high deficits and the inventories are getting back to a normal level, I think we will get quite interesting markets. For example, just to mention, the last oil crisis in the end of the 70s was when Saddam Hussein attacked Iran, and that took out approximately exactly 5% of the global oil supply, because Iraq and Iran were around 8% of global supply. Maybe to the next slide, Alex, we can look at this shale industry as well, which we have seen new Saudi Arabia virtually coming on stream with a lot of cheap money, and due to the collapse in prices and obviously not availability of capital, which started already much earlier than this COVID crisis, but the drilling rigs are actually down to pre-COVID, pre-oil, shale oil boom. So we'll see probably a very sharp decline in production, as it's short cycle, so it should react with 3 to 6 months to drilling. And we have to keep in mind that the whole size of the US shale industry was at its peak around 9 million barrels, which is the same size as Saudi Arabian exports. So on the next slide, Alex. So we can go to copper, which is also something which applies to all the metals and oil. Here is a chart which shows the historical copper grade, which is just coming down structurally. Of course, when you have high prices, which you have seen historically, then you have short, or vice versa. If you have low prices, then the grades are going up because you have to shut down the low-grade mines because they're not economic anymore. But this is a structural problem in all the commodity industry. It means you have to you have to have higher projections of costs. And we have to bear in mind that we have to replace every year 3, 4, 5% of production, meaning we have to bring on 2 major mines in the size of Grosberg, etc. And of course, this is difficult, and particularly it needs capital investment. And if you see a chart structurally with profitability going down, you would assume that the copper or the mining industry needs to expect rising prices every year, because obviously they would need to replace the production with other projects which are higher cost. But of course, this is not happening, as the mining industry or the oil industry needs a margin of safety and calculates their project with much lower prices than actual prices, which are already very low. And obviously there's a simple conclusion that we're going to have declining production for the next 10 years. And here it's, I think, a good illustration. One can argue when it starts. I mean, I have to add that from our experience, the mining or the analysts, I have to say, are quite optimistic or overestimate the supply, because it's always blue sky scenario. They take the projection of management and add it up. But in real life, you have things happening, like being Mother Nature. There are storms, there are shutdowns, there are outages due to hundreds of reasons, meaning that in historical terms, you always have an outage of around 5% of production in average, which is usually in the projections not taken into account. And then if you look here at the explanation or the word expansions, I mean, there are not all of them expansions, because some of them are going underground, meaning it's a very different way of mining, much more costly. And it's not just an expansion because it replaces the old open pit mines. But I mean, in general, due to this general underinvestment, we going to see declining production in many commodities for the next 10 years. And of course, we could add a lot of nice charts with demand projections, which copper would be very bullish, of course, and it's due to the new 5-year plan of China with Silk Road. I mean, they still consume only a third of the natural resources per capita compared to the West. India has a third of the copper installed as China had virtually 20 years ago. And if you would go to the decarbonization, which as a matter of fact needs more carbon as well, but I mean, then you would end up with figures that are just funny. I mean, a little example, there's a study from World Bank which projects this thing, and a little commodity like silver, which is a byproduct of copper, gold, or nickel or zinc, lead, has an actual annual production of 27,000 tons, and it would need a compounded production of 400 million tons in addition, 400,000 tons in addition. So it would mean a 20-fold annual production for this decarbonization and change and stuff like that. I mean, that's simply virtually a joke, because the production is going down because there has been underinvestment. So I think, to summarize, it's quite clear that the world will face quite tight situations in the supply of many of these natural resources, being it in the carbon side, but also obviously in the metal side.
Thanks a lot, Urs. With that, I would like to hand over to Marcos again.
Yes, thanks, Alex. Just a few minutes on value. I would like to defend a little bit the value, because we see that a lot of value guys are losing faith. Recurrently we hear about Warren Buffett is obsolete, or value is not working, or comments like this. And if you take the performance of value versus growth since the 70s, it is true that the past decade growth has really outperformed value by a large chunk. So this has happened in the past decade. But if you go to the next slide, you can see that this outperformance has mainly happened in the past 5-6 years. So historically, both growth and value have been moving up and down and meeting themselves and converging themselves again and again. But in the last 5 years, growth has been surprisingly very, very strong versus value. We have an idea, we think why, that we can see in the next slide, is basically, if you go to, and I was checking the indices, the MSCI World Value and the MSCI World Growth and the MSCI totals in the 70s, and the three of them have done more or less the same performance, 9% per year for 50 years, or a bit more than 50 years. So, and this is normal because, these are global magnitudes, so they cannot really differ too much from the main driver, which is the GDP growth, the nominal GDP growth. So it's quite normal to see that these indexes converge in time. And why value has underperformed, in our view, because the last 5 years has been, very, very disappointing regarding the macro and the fear. In 2015, we had an almost crisis of China. A lot of participants were thinking that China would collapse in 2015. The stock market corrected heavily, fear was on. In 2016, we saw the Brexit and the winning of the President Trump. In 2018, we saw the inversion of the yield curve in the US. And this is, one of the triggers or one of the early indicators of a recession is the yield curve. So in 2018, we saw a fake recession, markets collapsed again. And then in 2020, the final real recession with the COVID-19. So this explains a little bit why value has been underperforming the last few years, because when the cycle was expected to normalize and to go to consolidation and have 3 or 4 good years of coordinated global growth, we always had either a fake recession or a real recession or some fear here and there. And just in terms of valuation, let me highlight something very fast. Technology is close to peak multiples. It is trading at 8 times book value, just to take a reference. And in the peak of the tech bubble, of the dot-com bubble, it was trading at between 10 and 12 at the peak. This means that really, technology is quite high in terms of valuation. And this really, against energy, is striking, because energy is at the low end of the valuation. It's trading below book value when historically average long-term is close to 2 times. And you can see in the chart here how the commodities have underperformed. Commodities are probably part of value now because they are cyclical, and they go with the ups and downs of the economies. Although, as Urs was saying, the supply is more important. But look, in the last 8-10 years, what is the difference between the global sector and commodities? So, in summary, we think that we are starting the recovery of the cycle, and this will be, positive for both value and for commodities. Hand over to you, Alex.
Thanks a lot. Basically, let me just conclude on my side. The situation is the following. I mean, if you take, for instance, Apple as an example, we really had a very good, nice run with our investments in Apple, because we bought it back in 2011. But actually here on Bloomberg, if you just take mean estimates, in 2013, Apple was trading just slightly below 10 times earnings. And it has been trading at the end of August this year at 40 times earnings. Why was it so cheap actually almost 10 years ago? Because it was received, it was actually assumed that it's going to be the next Nokia. It was also hardly to believe already at that time that how can it be that a company can have a 500 billion market cap? And of course, Samsung started to take over the number of mobile phone sales. But if you look at the fundamentals, if you look at the earnings and the share price, we bought it really at a discount, while today the situation is really as if you basically have to take the 22 earnings and take it for granted, and you're paying a multiple of almost 40 times. Now, in the case of Apple, we would actually come back and buy it again if prices would be, or the share price would correct. With that, I think we would like to conclude. Thanks a lot for your participation. and we would like to use the same technology if it has worked well also in the future. Bye-bye from Switzerland and from Madrid, from Marcos.
Thank you.
Goodbye.
Bye.